Good afternoon, traders. Thanks for joining us today on this study hall session. It is June 2nd, 2022. Sorry about the late start. Um, a lot to handle all at the same time. This study hall is about active trade management. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. I invite you to ask questions during the session while I'm talking. So Yoda will keep an eye out and will respond or um, either respond to you or flag up the question to me. It's better for me to address it as it goes because once we get past the section, it's just hard to shift gears and go back, okay? So here's what we're covering today. We're going to talk about what active trade management is, who should be actively managing trades, uh, baseline move that we are trading. This is a key element. I'll describe it a little bit further here in a minute, but this is a big piece of this as far as active trade management. Using monitoring counter rotations versus continuation rotations. Of course, most of you know that rotations, real estate, what do they say? Location, location, location. In day trading, it's rotation, rotation, rotation. Using order flow to manage a trade. And then what about R factor? If we figure out this R factor offline, we try to structure our trades. Our goal is to structure our trades around R factors. And then all of a sudden we're actively managing a trade and the R factor becomes dynamic. So we'll discuss where that leads. What active trade management is. It's the process of managing a live trade while accounting for new data as the play unfolds. It's simply responding to and staying on top of, actively staying on top of what the trade is doing, and managing it as it unfolds. It is not to be confused with micromanagement, which is a bad thing, of a trade where excessive sensitivity to movement causes the premature closing or offsetting of trades. So micromanagement, which is actually an error, if you're someone who's tracking errors, micromanagement is when we're like responding to every blip. The market goes in our direction. We get in, we finally get a trade on. We suck it up and we put the trade on and it goes in our direction, moves 8 ticks in our direction, then it comes back 2 ticks, then it goes back to the high, and then it comes back 7 ticks. It's almost at our entry, and then we basically take a tick profit and are just thankful we got a tick and we didn't get run over. That's micromanagement because the trade is being managed from your entry. Active trade management is not that. So active trade management is based on inputs into the trade that got you in. So it requires certain characteristics. What are those? Who should be actively managing trades? Active trade management is not recommended for traders who aren't in the third stage of competence. So if you want to see what the stages of competence are, if you don't know what I'm talking about, just point your browser to ct.pro/stages, and you'll see the stages of competence. Most people who are with us are somewhere in the realm of lower stage 2 to upper stage 2 to lower stage 3, with as far as I know, with maybe several members who are solidly in stage 4. Stage 4 members tend to kind of use the service for other things like the news and whatnot, but the third stage of competence is the stage of basically conscious competence, which means that you are consciously following a process and have to think and be disciplined about doing it as opposed to just doing it without thought, which is the fourth stage of competence. Okay, so if you're someone who's not consistent, if you're someone who is who is reactive, who is a little bit anxious about trading, a lot of conversation in the head, and you don't feel, you come in the morning and you can't confidently, you don't confidently feel like you can take money out of the market, right? So when I made the turn, which was in futures, I made the turn once in equities in late 2001, and then I had to go to futures, and I made the turn in futures in late 2002, and I started my prop shop in early 2003. And the way it felt to me, and I'm not saying this is how it's going to be for everybody, is I knew that I was in the third stage because I knew what I needed to do. I knew I can really screw it up unless I was really specific and clear about what I needed to do. But as I was taking a train in or walking to work or whatever, back then it was just board of trade where I am now. If you ask me, hey, how are you going to do today? I can confidently say, I'm going to do something. I'm going to take something out of the market. I'm going to get paid today. I don't know how much or how, but I'm very confident that I'm going to follow what I need to do, and therefore will get paid. This is the mindset of someone who's been beat up quite a bit, has made the turn, and knows what they need to do. Okay, so that's the third stage of competence. The trader must be very clear about the basis and structure of his or her trade. You have to just really be very, very confident and comfortable about why you're even in the trade, right? So what's the structure that you're trading? So that means your process has to be really, really good and clear, and you have to be confident in that process. Trader must be comfortable with the emotions arising from trading and the open potential for loss. So this is the big one for most people. You put the trade on, and all of a sudden, it's deer in a headlight. We're mesmerized by where the market is relative to our entry position. You know, we look at the DOM, and the DOM has a big highlight as to where our entry is, and then we're comparing where the market is versus our entry, and that causes a lot of people to really feel a lot of emotion. The objective of active trading, trade management, is to maximize returns per unit of risk, or to get the most out of every trade, versus mechanical trade management, which is the counterpart. The mechanical trade management, which is what's recommended for those who don't fit the description of a third stage of competence trader, or a trader that has a process that is working for them, that they're confident in. We recommend fixed trade management, right? So you set your OCO orders, you put the trade on, and you just let the market do what it needs to do. And the reason we do that is because we want to anchor the trade management, because the entry and exit are discretionary, and so we need to anchor something. We anchor the trade management. It's the easiest one to anchor. You set a strategy, and then the market does what it does. So that's who active trade management is. And why is this relevant to you? Maybe you're not in the third stage of competence. Maybe you've come into the third stage and fallen out, depending on volatility, depending on the market regime, whatever. This is useful to you because this is what you're striving for. Okay. Again, the goal here is not to, remember our recommendation is a 3-lot micro trade, be it RTY, NASDAQ, micro ES, or micro Dow. A 3-lot, the first lot the recommendation is it covers, it doesn't cover risk, it takes risk off. So now you have risk off, you have the remaining 2 contracts have a total risk of the equivalent of 1 lot with risk remaining, right? So we did the math on this a couple weeks ago, I think, on a Thursday. And then once you get the second scale, the trade is in the money, and you just need to relax. By then, the rotations have taken it far enough that you can just chill and kind of let the trade work. So if you're trading a 3-lot on a fixed strategy, then it gives you a certain return. And with active trade management, you're responding to further inputs. You might actually move your scale outs and your targets farther out based on the action, or you might pull them in based on the action. We'll talk about that in a minute. I want to talk about a baseline move. Those of you who've been around a while have heard me talk about this. What am I trading against? And the example I want to use today is what was set up. So here's, man, I wish I could show you. Well, let me take a screenshot of it. So this is what I put in at 10:31:04. Let me just save this and then open it. Sorry, probably should have done this before, but we do what we can. Here's what I posted. This is in Chicago time, right? Decent structure. This was at 10:31, right in here, right after the blast off at 10:31. I said decent structure. Now against the 4108, 4110, 4108 being this high here, the IB high, 4110 being the LIS, this ledge, and all of these ledges from yesterday. 4110 is just a remarkable price that the market has really traded against a lot. So 4108, 4110, okay? And then I said targeting 4122, the double top. So the double top right here, you can see it better in this chart. Right there. So here's the 4108. And now what we're seeing here is an impulse, is an impulse move above the IB. So we've broken the IB high, we've got the IB stat. The probability of an IB low at this point becomes something like in the 28% range. I don't remember what it is for neutral, 28 to 30%, something like that. So I'm really looking to the long side. We've left all of our day reference or market generated levels beneath us, so that supports the long. So our VWAPs, mids, open, and opening swing and so on are now beneath us. And so we're looking for, we see that there's a weak structure here, 4122 double top. You see that double top there? And the idea is, okay, where do I get long? Do I get long here? No. Do I get long here? No. Getting long here is not too bad. But 4110 to 4108 per that post. And then we're targeting the 4122 double top. So that's somewhere between 12 and 14 points. The stop, as I discussed earlier in the chat room, is 3 points. So right there, we're getting 12 to 14 points versus 3 points, giving us a really good R factor with scale outs, gives us about a 2.5%, 2.5 R with scale outs. And then after that, we're going for the overnight high right up here, 24.5, right? Going for 24.5. So if you are trading mechanically, again, which is recommended for someone who's still working through their plan and their issues, it doesn't really matter what the 22 is or whatever, but if you're actively trading, what happens is you can extend your scale out to that 4122. As soon as it clears the 17.5, this lower high, lower high, lower high, this becomes the key area to push through. As soon as it clears that 17.5, you're good for 4122, but very high probability break higher. And then from there, if it does that, the next key reference or test area is 24.5. Beyond there is really 25 and 30. If you recall, big battle at 30 to 35. And we expect it to stall out at 35. Here's your 35. See how it stalls out over here? I talked about the 35 this morning. Huge battle there yesterday. Big size going through between 30 and 35 yesterday and the day before. So we expect a little pullback there. It creates an opportunity for a long at the 20, but let's not muddy the waters. Here, I really want to reference the fact that we're trading off of this impulse. That's the trade. And so if we enter here at 41.10 or 41.12 or 41.14, until we break down into this impulse, the trade can be actively managed and you can stretch the exits. So in this case, I'm looking for 41.22, I'm looking for 24.5, looking for 35, and then the ultimate is the magnet at 47, to which I said in the chat room, if you go look, I said, da-da-da, 4147 is the CVPOC in the region and the key target for any longs in today's session. This is a key magnet stock zone. As a result, expecting a bit of a stall here. And that's what we have. We have a bit of a stall here. Is this magic? Does it always work out this way? It does not. Is it magic? It's not. It's just common sense. But active trade management, as opposed to giving me a 12-tick stop on a 3 lot. So that's 12 times 3. So let's look at how this works out. Negative 12 by 3. Then we have plus 1 by 12 ticks for our first exit. The second exit is a full rotation, which right now is 24 ticks. And then the third exit would be either a multiple of the 24, so multiple rotations, or an impulse, which currently is about 60 ticks. So this is the mechanical trade management. Doing the math here, you can figure out what your R factor is, but getting in a 4110, let's assume we're geniuses and we just got filled at the bottom here. The 4110, the first scale is going to be 17, so that's 7 points on 3 points of risk. The second is right at the 22 because you have a double top here. It's likely to be breached, so it'll be 22. And so that's 12 points off. So we've gotten 7 points and 12 points. That's 19 points on 2 contracts. And then we're left with one more contract. And in this contract, I'm going to keep, even though we expect the 35, even though we expect the 24.50, we expect the 35, I'm going to keep this last contract. I'm going to keep it till when? I'm going to keep it until this, remember, we're trading off of this key rotation. I'm going to keep this until we see a true reversal, which is an expansion of our rotations, which is the next thing I'm going to talk about. See how these rotations are favorable, the counter rotations are not, until we see an expansion of our rotations and then a pullback, and on the pullback, we exit that last trade. And that's, we can take a trade that has, what is this? This is 3 times 12, so 36 ticks versus 12 plus 24 plus 60 divided by 36. So this is a 2.6R trade. This is a 2.6R trade as structured. If you do the math on the actively managed trade, it gets closer to 4 with the scale outs. It's substantially more. And that's the purpose of this. But the whole time we're in this trade, we are focused on what? The original basis of the trade, which is here. So one of the key things to remember, really, really important to walk away from, is when you're actively managing a trade, you're not managing it from your entry. So you're managing it from the basis by which you took the trade, which is an impulse higher breaking the IB, and you're trading a pullback. And unless that gets breached, there's nothing for you to do. And by the way, that is much, much, much more easily said than done. It just takes quite a bit of time to develop the confidence and the comfort to be able to hold through. So back to our thing. Actively managing is rooted in the original basis of the trade. As long as the basis of the trade is not breached, we hang on for our rotations. We shouldn't actively manage a trade based simply on our entry. So most people will put a trade on. Just ask yourself, you may be one of these people. Most people put a trade on and their entire management of the trade is a function of their entry. If you're doing that, chances are you can catch a decent runner here and there, but most of the time things get really choppy, which is okay if you're doing that, but it just means that when you do get a trade that goes, which maybe 30% of the time or 30% win rate, that trade has to give you a 10, 12R, 14, 20R to make up for all those times you actively manage a trade against your entries. So the goal is to really stay rooted in the basis of the trade versus my entry. Let me know if you don't understand what distinction I'm making there. I don't want to lose you in the process, but you might be getting lost in this. And that's how big traders trade. That's how somebody in the pit putting on, a 200 lot on the big contract, which is $250 a point, not $50 a point. This is how they can stop from, poking their eyes out as the trade is kind of wiggling. It's because they're not looking at, okay, where did I enter? They actually half the time they don't even know where they entered precisely. They know it's in some region, but they're basing it on the fact that maybe we went below yesterday's low and then we pushed higher and then we pulled back, they got in, and that's how they're trading, which requires you to use wider stops, which requires you to stay very, very objective about the structure of the trade versus your entry. Trading off of your entry is a very tough thing to manage trades with, okay? We must maintain a firm grasp on the root basis or structure of the trade and continue to be steady until that structure is breached. Easier said than done, but your goal as a trader is to be that. To be a professional, you have to get to that point, okay? We must be objective about how the trade is progressing versus how we are feeling about the trade in progress, which is the other piece of the puzzle. It's we're nervous, and then all of a sudden, for some reason, we can only see those things that are working against us. And then once we exit, we feel some relief. Then we go away, we come back, we grab a glass of water, go for a walk, we come back, the market has gone much farther. And then you squint at the chart very, very closely to ask yourself, why did I get out? I don't even see on the chart why I got out. I can't even tell you. And it's because you're watching the DOM or you are responding to some micro rotation that took place that is a natural part of the wiggle process. Monitoring counter rotations versus continuation rotations, you know, the market is moving up or down, and it's doing so on a fractal, depending on you if you're using a 1-minute chart or a 2-tick Renko or a 4-tick Renko or a PNF chart. It doesn't matter. It's just a matter of like zooming in and out. So there are rotations within the market all the time, all the time. And so one of the quickest ways to measure the way the trade the trade is progressing is to look at favorable versus unfavorable rotations. So let's take a look at this. So you could see that early on in the session, if your eyes can excuse me 1 second, just need a sip. If your eyes can focus on this lower pane, this is the rotations, okay? You will notice that this morning 1375 versus 14 and a quarter down, 1375 versus 975 down, 13 and a quarter up versus 13 and a quarter down, 1275 up versus 1575 down, 13 and a half up versus 10 down. And then we got something unusual. It triggers off my impulse indicator. It says ES zigzag high, this very perky voice that I programmed into IRT to give me that. Notice, we notice a 27-point rotation, and this is where, at this point, if you go back through the head trader log, you'll see me saying, okay, looking for a long into the LIS. I'm stalking for a long, and then it broke down and gave us a setup of 4090. At which point I said, okay, there's a setup there at the 4090 because this now gets my attention, and the rotations expanded to the upside. This tells me that one side has begun to exceed. These rotations are based on the market moving directionally without a counter rotation of 22 ticks or better. So as long as from the peak to the pullback, if we have a 21 tick rotation and it continues, this is considered one rotation. If it pulls back to 22 ticks and continues, then this becomes a new rotation. How do I get this number? Well, you get that number every Sunday night. In the rotations chart, it is based on statistics. So you can go and sandbox how you look at rotations however you want. You can look at the time frame. You can do it however you want. But the way I do it is just looking at the rotation chart, which is posted every Sunday and is in your downloads portion of the portal. Downloads under other, there's a chart there for rotations and it's set to 22 ticks. So as soon as it crosses the 16 point on 22 ticks, I get an alert and we get this counter rotation. And then what do we go to? We go to 5.75 by 10, 6.5 by 9, 1575 by 7, chop, 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 except for this tweezer top kind of just crazy move, chop, chop, until we get to this. And that's where you get something from me again in the chat room. Otherwise, I'm just commenting on every rotation. At that point, you got this comment here. Like I said, the idea is not to comment the whole time just to keep you entertained. The idea is to share what I'm seeing from a trading perspective in the head trader channel. And by rights, the RTY has been a lot more active, so you get a lot of input from Nanaimo and long, short, or flat. But honestly, in the ES, there isn't very much. So this is the rotation we're trading against. We're trading the pullback of the rotation. The first threat is the 1750 in my time frame, which is a 1 tick by 8. As soon as it breaks the 1750, I'm expanding my R factors based on the structure that I have: 2450, 35, and then 47. And then from here, if I have a runner, then I'm looking for the next key areas up, which is last week's high and settle, 55, 57. There's the 50, which you notice has a blip on it. The 50 is likely to shut the door here, so I'm looking for a rotation ahead of that 50. Like I said, I never got on this long. The 50, the century, the 50, the century, those always get a scale out. That's part of active trade management. I'm not going to put an automatic scale out behind the 50, the mid-century, the century figure. It's probably not going to get filled. And when it does get filled, it's probably going to run. So you want to be a part of that if you're going to take the risk of it being filled. But the next area to look for is the 55, 57, and beyond there, free and clear to 65. And then we see what happens at the 65. If it comes to the 65, and all of a sudden our rotations start expanding down at the 65, we got a massive rotation down, then I'm looking for it to pull back as if I'm looking to enter short, and that'll be the exit. And that's how I actively manage these trades. In general, I find that the strategy that I have in Edge Pro X in terms of the trade management is pretty good because it's based on rotations. But when I see that things are running, I immediately go and either cancel or lift or move my my orders in order to take advantage of what's happening. So favorable rotations are what the participants are getting, where the participants are getting price gains for their efforts. So we want to be on the side that is lifting, but is actually getting price progression, price gains. So those are favorable rotations. We want to see the people pushing against this. For long, those are the sellers. We want to see them really have a hard time. Again, to illustrate just real quick, to be clear, once we got this 29-point rotation, look at the counter rotations. Not much there. Very small counter rotation. So this is not a threat, even though, we're talking about a 12-point move down. It's not really a threat, right? And then we get another rotation, and now I'm comparing the counter rotation against this up rotation. Now I'm comparing this rotation to its counter rotation. So right now, this is where you get a comment from me saying, this is very likely to continue higher. I expect this to continue higher. Why? Because there's no factual evidence that it's not. But most people will respond to, oh my God, 38.50 versus 39.5, I'm out. Because lower high, lower low, blah, 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 blah. Look at the rotations. Look at the rotations. They're cleaner. Takes a lot more for traders to counter rotate the market. Mhm. Go
Someone
ahead.
was asking if you could explain again the difference between the 22 ticks and how it differs between that 16-point line that you're talking about on your zigzag indicator.
22 ticks. Okay. 16-point line. Where's the 16-point line? Do you know what reference that is?
I'm assuming the red line that you have on your rotation chart down there.
This is just an impulse. This is 16 points. 16 points. Okay. So that's 64 ticks. Is that math right? 32, 64. So 64 ticks. So the market rotates up and down in some fashion. Every market has its up and down rotations. Those are what are called harmonic rotations. We standardize them by taking a 1-minute chart, looking at the top price, the bottom price, top price, bottom price based on a 3-bar configuration. So it looks and it says, this is a lower bar, this is a high bar. As soon as I get a lower bar, I'm going to mark this as a high. So that's what our chart is. In fact, let me pull it up because you really, really, really need to know what this is. So here, I'm loading it. This is from your portal. I have a portal just like yours. This is from your portal. These are where the bookmap definitions are, the IRT definitions, your links, all that stuff. Under other files, if you click, it'll bring you down to this area that has all kinds of goodies. There's a lot of goodies in here, okay? And one of the charts is the convergent harmonic rotations. That's updated by me every Sunday. So May 30th, that was a Sunday. And it'll show here the pullback zigzag, statistically speaking, is 22 ticks. Let's not get too bogged down with how the 22 ticks came up, but it came up statistically. We can see the impulse, so ticks, the impulse is 16 points for the ES, 62.5 for the NASDAQ, 8.4 for the Russell, and so on. So that's the 16-point line. This is the 90th percentile of all rotations. It's hard for the market to get to 16 points. And once it does, something unusual has happened. Okay. And a normal rotation is 10 points, 10 and a half points. So we're comparing 16 points to 22 ticks. You have this information just like I do. And what I'm saying is, if I change this 22 to something like 100, what do you think will happen to the rotations down below? Take a guess. Let's see if you understand this. Let's use the Socratic method. What would happen if I changed the rotation zigzag, the pullback zigzag, to a very large number like 100 instead of 22? What do you think will happen?
They are not visible any longer.
They're visible because we're probably going to get a 100-tick counter rotation, but something's going to be visible because um,
Very
because
fewer impulses. It wouldn't
correct.
show much details, one big rotation.
Exactly. See? Why? Because it has to move 100 ticks from the last low to the last high. It has to move 100 ticks against that move in order to generate a new rotation. So now it'll just keep, as long as the range keeps expanding, this rotation continues because there wasn't a 100 tick or better counter rotation. So this is a significant part here, significant piece. And if I went with 20 to 100 ticks, then my impulse, I'd have to go correct the spreadsheet, recalculate the spreadsheet. My impulse is now going to be a 90th percentile move is probably going to be, I don't know, maybe instead of 16 points, it'll be somewhere in the realm of 80 points for it to actually say, okay, this is an unusual move. And so far we have 76.75, you see? So the more, the smaller the counter rotations that I input into this to create the next rotation, the more rotations I get. And that is based on statistics. So if I'm on a 15-minute chart, that zigzag tick pullback number will be much higher because it takes a lot more movement on a 15-minute chart to form a top, a swing top, and a swing bottom, and another swing top, and another swing bottom for us to get those statistics. Let's not get caught up in that. That's its own webinar, probably. So we monitor rotations, counter rotations. We expect counter rotations. The market's always going to move against us on some level, but are they becoming more significant? Are they increasing? Right? That's really important. That's why we say rotations, rotations, rotations. In fact, I can state this confidently, no guarantees. If you were to shut down everything that I'm looking at and just give me a DOM and a chart of rotations, I can scalp that chart profitably. I would say with 99% confidence that I can make money on that chart. Just looking at rotations and a DOM that allows me to input and manage a trade. It's not advisable because you would probably increase your costs dramatically, and you have to be very prepared to use order flow to do that. But the rotations are really important. Are we near or at any key reference points? How is it responding to a key reference point? You have a market that's rising, rising, good rotations, good rotations. We get to a key reference point, and then all of a sudden, the counter rotations start increasing. So here's a key reference point, and we managed to pull back 22 ticks or more. That's where we put in this counter rotation. But here, I would expect the market to start building a counter rotation that looks like this. I expect it to hold down. And as it doesn't, and it continues to kind of push against it, this is an indication that I need to hold on to my runner. So in this case, if I was long and I had a runner on, there is nothing for me to do here. Nothing. Because the counter rotations are really not getting any advancement. As long as rotations remain favorable, we let the trade work. That's the basis of active trade management. Using order flow to manage a trade. So, to describe order flow is the process of closely analyzing bids, offers, prints, right? We're looking at, let's look at the DOM here. Order flow is looking at offers, bids, looking at bids up and down. Okay, what's bid? Okay, and prints. What's actually printing? Your charts only show the prints. If there is no print, there is no chart. The chart doesn't show you the intent or what's offered and what's bid. The order flow is basically looking at how is it acting against the orders that are resting, how is it printing, the velocity, how is it gaining price with every print. That's what order flow is. It's a much more, it's like information overload really for people who are still trying to figure things out. I recommend you don't worry about order flow. It's a lot more information to process. So we're looking at how they react to each other on a continuous basis relative to expectations. Order flow, when used in a vacuum, can create a lot of noise and is considered a more advanced way of analyzing the action. Order flow essentially goes down to the very micro piece of how a chart is formed. It's looking at every trade. Order flow when analyzing a vacuum can create a lot of noise. It's considered a more advanced way of analyzing the action. Imagine we are long. If the market moves in our favor into a key reference and we see a heavy offer that remains firm as we approach and our scale or target is above that heavy offer, then active trade management demands that we move our exit below that area. So what does that look like? Let's say my exit is 53.75. I can see there's a block trade at 53 and a quarter. I'm able to see this block trade because of Rhythmic, right? Because of MBO. But I'm looking for a scale out because of the way I've coded my strategy, my mechanical strategy. I've got a scale out 53.75. Am I going to sit there and wait for this to be eaten through so I can get 2 more ticks? In this case, I'm risking potentially the market counter rotating 10 points just to get 2 ticks. Active trade management says I got to pick the order up and move it to 53 quarter, 52.75, wherever I think I'm going to get filled, simply because of order flow. So that's another input. It's not just price action alone, price action being, oh, we went to 10, we went to 11, pushed 22 twice, pull back to 10, trying to get in it. That's price action. Lower high, lower low, lower high, break 1750, look for a follow through, which we got. That's price action. Order flow is, hey, there's an iceberg in here, or there's a big block order that keeps sweeping, right? It just periodically comes in and just flushes the market, and the market comes back, and it flushes the market, and it comes back. I have to adjust. Active trade management really demands that we look at order flow. This is why it's a more advanced way of managing trades. So that's the piece relating to order flow. As I'm wrapping up here, we're watching for icebergs, block trades, big areas. So that's the example I wanted to show. And then the last thing we wanted to talk about is R factor, because we say at the very beginning that R factor is a very, very, very important piece. R factor is a measure of return per unit of risk. Having a high R factor, we believe, is the single most important or most impactful feature to a trading plan. So you could have the best trading plan in the world, but if per trade you're risking a lot more than you're getting on the trade, it's doomed to fail, or it has to have a very, very high win rate. As we actively manage our calculated desired R factor is becoming dynamic. So as we actively manage a trade, when I go and push my exit from 53.75 because of this order, and I move it to 52.75, of which only was 21 traded, I'm impacting my R factor because I'm giving up 4 ticks times whatever size I'm holding. Let's say it's a 1 lot. I'm giving up 4 ticks. I'm decreasing 4 ticks on this one scale out. So my R factor's changing as a result. Who does not understand this? Who is confused? Anybody? Let me know if you're confused. This is important stuff. But as I'm managing the trade, so if I set my strategy, as I said earlier, 16 tick stop, 16 tick scale, or 12 tick stop, 12 tick scale, and then maybe a 24 tick scale and maybe a 60 tick, 24 tick scale and a 60 tick exit on a 3-lot plan, I can compute what the R factor is there, and I did. I think it's still on the calculator here, 2.66. But if I go and I mess with my exits, my scale outs and all this stuff, I'm changing this. I don't want you to get hung up with the fact that we're changing this as a result of active trade management, because even though we're changing it, we still are looking for a favorable R factor. We cannot change it to the extent that we take a trade that normally would get us 2.66, or what was the number? 2.66 R. We can't change the trade so terribly that it becomes a 1R trade. This is an error. This is over management of a trade. So even though our R factor is becoming dynamic, and you kind of need to keep that in the back of your mind. Okay, I gave up 4 ticks on my second scale out, and I gained 16 ticks on my first scale out because I pushed it to 22 instead of taking a scale out at 14 from 10, let's say. You're kind of keeping a tally in the back of your head that it's not gonna be 2.66, but it'll be something. So we don't need to be accurate on every trade. So if we have an 3R trade setup, we might end up with a 2.97R or a 3.12R. Let's not get hung up on it. The R factor is still key. We don't throw it out, but understand that as we actively manage trades, the R factor starts to wiggle, right? It starts to change from trade to trade to trade. What is key with R factor is that we don't simply throw it out because we have to change our targets as the market moves for or against us. We must still track how well we did as a unit of risk. Very, very important. That's all I had for you for today.
There's
Are
some
there any
questions.
questions outstanding? Mm-hmm.
Yes. How do you adjust when you change strategy from mechanical to discretionary and begins to skew your results in a negative direction?
Well, if that's the case, then I need to go back to being mechanical because clearly I'm introducing something more than actual market data into this. What's happening there, in my experience, is as we move from mechanical to discretionary and the results take a hit, we're bringing psychology into this. We're bringing our baggage into it. Um, the only thing you can do there is move back to being mechanical. Just be mechanical, know what you're expecting, keep adjusting your exit strategy, and then work on your entry, your bias, your context, your entry. But as soon as you introduce active trade management and all of a sudden it looks like you're just taking a hit after hit, the thing that has changed, unless there's an abrupt or an unlucky um, dramatic change in the market that your trade plan is not working anymore, which is unlikely, then it's very, very likely that that we're introducing ourselves into the trade. Right? We're expressing ourselves in the trade, meaning that we are bringing in things that maybe we're taking trades, we're seeking out trades as opposed to waiting for them or whatever. And the best thing you can do there is just go back to being mechanical. Be aware that there's an issue that needs to be worked out. There's something we're introducing that is causing that adverse outcome.
There's a few traders wondering about that move from mechanical to discretionary. And one of the questions is, when would you recommend one begins to adjust their stops and targets instead of relying on a template on the trade and leaving it? Does this tie into performance metrics?
You have to have a positive expectancy, a strong positive expectancy, pretty consistent. Really, there's no point just because you had 1 or 2 good trades and you feel like I'm a master of the universe. I caught this huge trend yesterday, so today I'm a super trader. The market is going to punish that very, very quickly. But here's the thing with this stuff, and this is based on just my experience with traders. You start to get to a point where you feel like it is just dumb for me not to um, introduce more charge into my trading. That's what it feels like. If just like increasing size, it's the same criteria where it just feels like, I'm trading a 3 lot MES. Will a fourth lot make a difference to me? Nah, it's not going to change anything. It'll give me another opportunity to exit. But as long as my full stop outs stay the same and I'm trading the same and the market can bear it, which it can, then it just becomes very easy. It's kind of like being a nervous new car driver who's monitoring your mirrors and holding on to that steering wheel at the 10 and 2 o'clock location positions, to one day feeling like, I got this. I can take one hand off the steering wheel. I can relax a little bit. It's a natural feeling, but it is supported. Let's say you're coming to me now and saying, "Hey, I want to be authorized for 3 contracts." I'm going to go directly into your um, performance, and I'm going to look for a steady expectancy, rising numbers that really describe your confidence. So it's not something like, oh, I've worked out the math on this trade and I've worked out this setup, and because I just did, I'm just going to go tomorrow and 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 do something different. That's not what it takes. And actively managing a trade, by the way, means that you're sitting here as opposed to just letting the strategy kind of do its thing. You're sitting here actively monitoring what's going on. So it's a whole lot of attentiveness to do nothing, right? So my rotations didn't change, so I'm going to stay. But as soon as it's, turned down, now I'm just watching. Okay, does this expand? Do we get more bars coming down? What does it do at this 35 area from like? But you don't do anything. It requires a lot more focus, but it also means you don't touch it. You have to just it's like, think of a pilot on an airliner flying across the ocean, a flight from London to New York. These guys get on the flight. They have a flight plan. They get to their whatever they're called, their waypoints or whatever they're called, and they might program that flight plan and flip a switch, and now it's on autopilot, right? And what you're doing when you go mechanical to active is you're flipping that autopilot switch off. And let me just turn this off. You're flipping the autopilot switch off, taking hold of the controls of this airliner to do nothing. You're still going to follow the same plan, but now you're actively watching everything that's going on as opposed to the computer kind of doing it. So you're introducing a layer. There has to be a return for that. And the return for that is to say, look, like for example, for me, I always have a strategy programmed in here. So the strategy manager is right there. It's enabled. You see the thing is green at the bottom. I have the ES strategy going. I have an ES default ES scalping strategy, and it's always there. You see those orders? They're always there. There's one that's way off in the distance, but they're always there. But when I enter, I'm going to pick up those orders because they're OCO orders also, in case I get knocked off. I pick those up and I move them as needed. I'm actively managing the trade in that situation.
Okay.
So when do you go to it? You go to it when you're very, very confident that you can stick with the plan, you can see the information to the left for what it is, and you can squeeze more than just a passive trade management scheme. And it should feel very natural going to active trade management.
Sounds good. Someone was asking on that post that you made about the 4108 targeting 4122 wrong below 6.5. They're wondering, what were you leaning on for your risk, and in other words, where would the trade be wrong?
This particular trade here is wrong below this would be a fixed. So I'm leaning on this structure and the IB. I don't have the mid to back me up. You see the mid is way down here. So really I'm leaning on a fixed stop, which in this case would be 4 points, and this structure here, period. So the stop down here, the technical stop is 6.5 points, but to me at the 10 will be 6 points or so, and it's done. So that fits. And the way I see that is I go down to the 4110, because I just don't like to think. And I can see that where it says 2 down there, I can see that that's below the IB. It's a 4107. In this case, it's a 3 lot. I'm going to drag that down to 4106. I can see the 4106 is just below the zipper right here. That's good enough. And then what I'm going to seek is 4 points on my first scale because I have to offset that risk, a portion of that risk. But it's usually 3 to 4 points on a structured trade. It's not much more than that unless volatility gets a lot bigger. Okay.
Okay, that's great. 2 questions to wrap up. On your runner, are you expected to move the stop up so that the trade doesn't become a loser?
So I don't want to get into that too much, but for me right now, it really has to get below this 25. So the best I can do is 25. I used to, when I catch a trend, I'm really looking at 2 rotations back. So let's say we're here. I have to look at this rotation. That's 1 rotation. I have to look at the rotation behind it. So now we're up here. So now I'm 2 rotations behind. So I'm looking at this rotation, this rotation. So now my stop technically would be 41.38. I did that quite a bit. In fact, I did it, I talked about it in one of our risk management webinars. And what I noticed is that I'm taking myself out when really not much has changed in the trade. It's more of a defensive approach, but I am actively looking at what this trade is doing. The trade for this, if I were long here, the stop itself wouldn't have moved. I'm actively managing this trade. The only reason I'd move a stop is because I'm getting up and I'm going and doing something else. For me right now, all I'm looking for is this thing starting to expand the opposite way? And I found that that's what keeps me in the trade for long. Nice sweep there for 424 just now. That's what keeps me in these runners for a long, long time is I have to wait and see that the rotations are expanding. You see those little red bars there? See? There's no threat to the buyers, no threat. So there's no reason for me to come and maybe use this 39.75 low for a stop and then get taken out before it continues when nothing has changed for the buyers. As long as I'm in a runner, I'm going to look at rotations to manage how the runner's managed. Okay.
Great. Last question before we wrap up. Where can I read more about this rotation indicator?
I don't really know. I've done a ton of videos. I have no idea. There's probably a webinar on rotations somewhere. See if you can find a webinar on rotations and try that, but I can't point you to a particular video. But it's a theme that's been, I talked about this on Futures IO 10 years ago, I'd like to say. It's just something that's been around for a long time. It's how I've looked at the market for a long, long time. So I'm not sure what resource you can use right now, but it's definitely been covered.
There's
Okay.
a rotations and zippers webinar.
Yeah, so go in the portal, go in the member portal, go to the little search thing at the top next to your name, and maybe type that in, rotations and zippers, and you might find it. Okay. Anyway, we went way over. Thanks for listening in. Hopefully you gained something today. I'll get you guys in the chat room, and thanks, Yoda, for moderating. Take care.